What is up, everyone? Hopefully, you're all doing well. Today, we're going to be breaking down my $100,000 stock portfolio at 18 years old, and I'm going to give you a rundown of how I got here, what my goals are, my investing philosophy, and all of that stuff. So, let's get right into it. Now, my portfolio sits at about a $98,000 value right now. 11.5K of that is cash. If we look at just these stock positions, here is my portfolio. Okay. I just started investing when I turned 18 at the end of August. I opened this investing account in September of 2025. So it's been what, like 9 months now? Or yeah, 9, 10 months now. So my overall philosophy with investing and my overall goal with investing is to beat the S&P 500 long term. Now, I believe I can do that. I'm young, I can handle the volatility, and I have a ton of time to put into research. Okay. So when I'm not doing my main sources of income are my day trading and my day trading mentorship. When I'm not doing that, I am trying to improve as an investor and get to $1 million as fast as possible. Let's break down my portfolio and my portfolio plan. Now, these weights are not final. Yeah, I just started a lot of these positions recently. Like you can see, they're like basically a few of them are pretty break even or pretty recent. The ones I started recently are Amazon, Meta, MasterCard, Netflix, Uber, and S&P Global. I've owned Microsoft since September, Google since about then, Nvidia since then, TSM since then. Um, Uber since then, or not Uber since then, ASML, Broadcom. So the four AI semiconductor stocks I've owned, that's why they're up the most. So let's go over here. We'll check my year-to-date performance. I'm up about 8% year-to-date, which is not great. You know, at one point we were up about 16% year-to-date. It's actually more than that if you don't include the cash. But some of the cash brings it down. So if we don't include the cash, I'm up a little over 8% year to date. Okay. You can see my holdings over here match up with my holdings right here. Full transparency, I will be fully transparent. So let's get into why each of these stocks and my plan. Amazon, I believe I started this position last week. It is down a bit. I bought on the dip, but I didn't catch the bottom. You're almost never going to catch the bottom. It's about 17% of my portfolio right now. It's going to be, in my opinion, one of the largest winners of AI, not just with Amazon Web Services, AWS, but also with robotics. I think it's in a great position with robotics. And Zoox, I think, can take some market share away from Waymo and maybe even Tesla in the future if they ever lock in. So, Amazon, I don't even need to talk about the retail portion and the online commerce portion. AWS, robotics, all of it, I believe, is positioned really well to benefit from AI. Microsoft is my largest red position. I'm down 15% so far on Microsoft. I bought it on about a 25 or 20% dip and have been adding a little to it recently, and I'm still down pretty heavily. I'm down, I don't know, 15% here. I believe Microsoft is handing AI to enterprise and to employees at large companies on a silver platter. I think that Microsoft products are going to be one of the first ways that majority of people use AI in a substantial way. It's going to be integrated into the whole Microsoft work suite. And Azure is growing fast. It's going to take market share from Google Cloud and AWS, and I believe it's the second largest behind AWS, and it's growing really fast. Meta Platforms is a new position I just added last week. It's about 12% of my portfolio. I'm down about 2% on it, only $200 on the position. It is worth about $10,000. So Meta, I think Meta is really the only company right now that is showing that it can use AI to 100% increase revenue. It's the only one that's really proved it. Like, out of these hyperscalers, Meta is the one proving itself to be able to use this to target better ads. They're building out insane infrastructure so they don't have to rely on anyone else. And honestly, investors are really scared about the capex with Meta. I'm not really worried. I think that if anything, it's short term, just investor fear, and that's what I want to be buying. There's a reason I bought Meta here, and there's a reason I'm only down 2% on it because I bought the dip, right? So we can go over here to Meta, go over here. I bought it at a 30% dip. I bought it right about there. So a 30% dip from all-time high below the 2025 open and 2026 open. Okay. Now, moving on to Alphabet. Google. Google is, it would be so much larger for me if I didn't miss that move up. Honestly, I didn't have a ton of money in it on the move up, so I had to add at not a great price. So a lot of this position was added at a not a very good price, so I'm only up about 4% overall. I think majority of that add was like right about here around the yearly open. Um, it's you're not going to catch every move, right? I added a little bit more today at this equilibrium of the range. If we can get to the yearly open, I'm not going to have deployable cash for a little bit because I did just deploy another 10,000 today. So, I don't have a ton of cash to buy more when we get lower, but hopefully if we can stay down on Google and Meta and Amazon and Microsoft, if we can stay down for another couple months, I'll be able to add another $10,000 in August, another $10,000 in September. I front loaded my $10,000 for July. I added it early just because I really liked the prices that all these stocks were trading at. I believe Google's going to be a massive winner. It's proven that ChatGPT and Claude aren't going to take away from its search business. Gemini is an amazing model, and people are so used to Google, and Gemini is integrated so well into Google. YouTube is an amazing business. Google owns majority, if not all, I believe just majority of Waymo. Waymo's the only company right now doing actual rides, autonomous vehicle rides. So I believe Google, Amazon, they're like both ETFs on their own. There's so many businesses inside of the business that I feel so confident having really large positions in these stocks, but Google is just a bit smaller because it's at a pricier valuation. Okay. Nvidia, I have about as a 9% position right now, 13% in the green. It's not going to be a large position for me. I'm likely not going to add to it a ton. Same with, I'll just go over Nvidia, TSM, ASML, and Broadcom right now. These have been pretty big winners for me, especially TSM has been a pretty big winner for me. I've trimmed these positions heavily. I've trimmed TSM heavily, same with ASML and Broadcom. They're a lot smaller now. They were larger, but their ASML especially was getting to such an extreme valuation that when I ran DCF calculations, it just, the returns in other companies were going to be better in the future. Those calculations showed. You would have to assume really high growth rates to outperform. Okay. So that's kind of my thesis with ASML, Broadcom, TSM, and NVIDIA. Looking at MasterCard, it's its own duopoly with Visa. So MasterCard's about 8%. I like it around this range, 8 to 12%, 8 to 10%. I think it fits really well there. The cross-border transactions are really a big part of MasterCard's moat. The duopoly with Visa, like I mentioned, the value-added services, just the built-in trust that MasterCard gives. It's a great diversification play across my large cap US tech stocks. Looking at Netflix here, it's about a 5% position. I'm down about 7% now. Netflix is down really heavily from all-time highs. So if we go over here to like a monthly chart, we are down heavily from all-time highs here on Netflix. Down 45%. At one point was down 47%. Meaning from my position where I'm down 7%, meaning I'm in about here, from my position, getting back to all time highs would be about a 77% gain. I believe Netflix has a lot of room to grow. I'm working on a full thesis right now with Netflix, like typing up an entire uh, thesis on it. I think it's a great stock, and I love it being in that 5 to 10% range for me. I think that I was reading, and only a small portion of televisions in the world are smart televisions. So it's not easy for a lot of people in the world to just get Netflix, right? So as we get more advanced, and you know, Netflix is already spread pretty heavily through the US. Majority of people have Netflix, but it's the rest of the world that doesn't. And I think we're really going to see Netflix grow into that. If Netflix can get some more classics, some more Stranger Things, nothing's probably going to beat Stranger Things out. Like, that was one of the biggest shows I've ever seen as a community. Okay. But if Netflix can grow into its worldwide audience, the ad tier that they added, so they have the subscription tier with I believe it's like 19.99 or something like that a month. Then they have the ad tier, which is like 10 or less than $10 a month. That's growing a ton. I think AI is going to help target those ads better. AI is also going to help recommendations for shows, which is going to keep people on Netflix longer. Okay, and I believe my generation is even more dopamine addicted to the fact that they're going to be watching shows even more. They're going to be on Meta even more, Meta's platforms even more, watching Netflix more, watching YouTube more. I'm directly benefiting from brain rot, essentially. Next, you have Uber Technologies. Now, I bought Uber 3 days ago, or I bought it right before Pelosi did. So I timed it absolutely beautifully. You couldn't make up the timing. I bought Uber on the 22nd, I believe. Yeah, so a week ago now. Bro, literally 2 days after I get it, Nancy Pelosi's report comes out on Twitter that she also added Uber, like $1 million worth of Uber calls expiring in 2027 or 2028. A big worry with Uber that investors have is one, margins, and two, autonomous vehicles. Now, my thought on autonomous vehicles disrupting Uber is pretty simple. People are going to want a way. It's not just going to be one company that's running uh, like rides. Okay, it's not just going to be Uber who's doing rides. It's not just going to be Waymo. You're going to have Zoox, you're going to have Tesla, you're going to have Waymo, and you're going to have humans. Uber, I believe, will become that platform that you go to book those rides. You see who's closer, you see who can get you a better rate, who can get you there faster, who's safer, who can fit the amount of people you need, things of that nature. I think Uber not only has by far the largest share of human drivers, but I think they're going to mesh into be the platform where you book rides, which is going to be insanely good. There's going to be like no spend with that Uber technology there. It's going to be they're just taking a portion of that revenue. They're not building out any physical products. I think I really like that idea with Uber. It's a bit riskier, of course. That's why it's a 5% position, just like Netflix is. And then ASML and Broadcom, like I mentioned, are my semiconductor plays, as well as TSM and NVIDIA. And then S&P Global, this position will get larger. I just added this last week. We're down heavily on S&P Global. Investors are scared about the AI risk with it replacing their market intelligence business and their credit rating business. And I think it's fluff, down 30% from highs. I think businesses are going to trust humans with their debt issuance more than, or their credit rating more than an AI. And I think the AI can help. And I really think S&P Global is going to benefit from AI. It's going to become more efficient. But when you're credit rating such a large uh, loan or whatever it may be, it really, really, really cannot have mistakes. And if you use AI in conjunction with human, I think that's your best bet. So those are my portfolios. Or an S&P Global also is the S&P 500 and the Dow Jones. So they get a fee every time an ETF connects to something. For example, like VOO, the Vanguard S&P 500 ETF. So that's my portfolio right there. I'll get into a little bit more of my details here in 1 second, but overall, I'm looking to outperform the market long term and reach $1 million. I'm adding about $8,000 to $10,000 a month right now into this portfolio. I just started this portfolio recently. I'm short on cash a bit because I did buy some land. Um, so I'm short on cash. However, I did add the $10,000 for next month already. So I won't add anything in July. Next time I add will be in August. All right. So let's go over here to a DCF calculator and I'll give you guys a little bit of a rundown of all the stocks and kind of the returns that I expect with these stocks at the prices that I bought them at. So we can go over here to Meta, and for your EPS growth rate, I'm going to use earnings instead of cash flow. Cash flow is a bit slippery because of the capex and all that stuff. So I'm going to use earnings. It's just easier. EPS growth rate. Now we can go over here to the insights page. We can go to Meta and we can see here revenue is growing 33% in the last year. EPS 62%, but obviously not 100% accurate. So I think we can assume healthily a we could even go with something like 20% EPS growth rate. Like we can be so conservative about it, and we can be so conservative even about the EPS multiple being a 22. It's currently at a 19. So like do we really expect this multiple compression to stay? No, I think you're going to get earnings growth and multiple expansion. So I think at minimum, you're going to be at a 25 PE ratio for Meta. You're going to get some type of multiple expansion. However, I'll be um, a bit frugal on this end and go with the 23 for an appropriate EPS multiple at a 20% EPS growth rate. You get a 23.4% return, or a 23.4% return over the next 5 years. Okay. Now we can look at Uber here. Uber, we can go with Uber's a bit interesting. It's a bit more speculative. It's harder to give an exact estimate. We can go over here like this. Boom. Look at revenue growing at 14%. Trips are growing at 19%. Uber One members are growing at 60%. Gross bookings growing heavily. You can't really look at EPS here. It's a bit difficult to gauge that. It might be better to use free cash flow yield, honestly, but we can just deal with it. We'll go over here, Uber. We'll plug in, let's say we get a 25% growth rate here on Uber. It's starting at 18.5 while down 30% from highs. I think it can trade up to a 22. 22 and 22 seems like a pretty good number there. Even if you don't get multiple expansion, you get purely earnings growth. You stay at a 19 PE. Even if you only get 15% EPS growth rate, you get a 15% return, which is my goal for my portfolio. So I think this is a good stock. Okay, we can look at Microsoft. Microsoft, it's a bit of a different story as well because you have those OpenAI concerns where a lot of their revenue was strictly from OpenAI, like such a massive amount. However, I look past that a bit. I look at their cloud backlog, which is insane. I look at their 365 consumer subscribers, which is growing well. Everything is growing well. The free cash flow, the capex, and the spending is getting a bit out of hand. I agree, but EPS is growing at 23%, 20%, 16. Okay, so I believe analyst estimates are like 18 or even 20. I can't remember, but we can go with something like a 16. If we go with a 16 on Microsoft, it's going to trade at a premium multiple because it's a premium company. I believe that at a bare I'm being extremely conservative. I think a 25 PE is extremely conservative for a company the quality of Microsoft and how embedded Microsoft is. Um, I think a 25% rate or a 25% EPS multiple is conservative and will probably happen. Okay. Looking at Netflix here, I believe EPS was growing at like 7% or 8%. It slowed down heavily. Um, Again, you can't gauge their EPS growth rate because of that Warner Brothers buyout. So I think we can just go with an even 10%. I think that's realistic. And it probably won't be valued as premium anymore. The market just has something against uh, Netflix. So even if it trades at a 24 PE, which is the exact same basically as it's trading at right now, and it's being completely disrespected by the market, you get a 10+% return. I think the EPS growth is going to heavily outdo this. I think you're going to get closer to a 16 to 25% EPS growth rate. I believe the stock's getting heavily disrespected. Google, this is one of the only stocks that I'm heavily buying or want to heavily buy that is already at a premium valuation. It's trading at a 25 PE ratio. Growth, we can go over here to Google and look at its EPS growth. Its revenue is growing 21% in the last year. Operating margins in cloud, Waymo growing heavily. Cloud backlog is insane. EBITDA growing crazy. Free cash flow again with hyperscalers is iffy. EPS grew 80%. Um, so let's be conservative again. And we can say Google grows mid double digits, sorry. And it's a very premium company. I believe it can trade at a 25 PE ratio to 27 PE ratio. We'll go with the 25. And even at today's current prices, where it's pretty heavily, I'd say it's fairly valued for the quality of company you're getting, but it's overvalued compared to its history. So I think that this is still an amazing buy. You're still probably going to get a 10 to 17+% return. I'd be very surprised if you didn't get a 10% plus return over the next 5 years. And I would not be surprised if you got over a 15. I think that's the more realistic scenario is over 12. Um, so that's Uber right there. And then what did we not look at? S&P Global is a different story. S&P Global is more of a diversification play without diversification. So I want to diversify to the best of my ability without feeling like I am diversifying my companies. Okay. So EPS growth rate at a 13%. Revenue's only growing at like 8%. However, with buybacks and how perfect the company's management, everything is, EPS growth rate of 13 is extremely reasonable. This company's going to trade at a premium EPS multiple because it has an extremely strong moat. I believe a 28 EPS multiple is perfectly reasonable. And that gets you a 14.8% return. For being such an insanely monopolistic or duopolistic company with Moody's, I think that is an amazing company, especially at these prices right now. Keep in mind, I bought a majority of these companies at their current prices, which are heavily discounted. Okay, looking at MasterCard here, let's actually go over here and take a deeper look at MasterCard. Let's look at their revenue. Revenue growing 15% year over year. Overall cards is growing 6%, I believe. Yeah, 6%. Free cash flow 28%, 16 over the last 5 years. That's good. The margins are getting great. Their shares outstanding are getting lower. They do great buybacks. They pay a good dividend as well. The valuation is extremely cheap. Okay. EBITDA getting, I mean, bro, this company is like, this company, when you think of amazing fundamentals, the free cash flow is a little weird, but I think when you think of amazing fundamentals, this is what I think of. Okay, so in last year, EPS grew 21%. I think it's safe to assume a 16% EPS growth rate for MasterCard. So 16% EPS growth rate. It'll trade at an extreme premium. I would imagine it trades at a 30 PE ratio, which would get you a 16.89% return. Okay. Again, this is a lot like S&P Global in the diversification without diversification pool. I think it's an amazing stock and an amazing company. And then the other ones you have would be Broadcom, ASML, TSM, and NVIDIA. Oh, we didn't do Amazon. Let's do Amazon really quick. Amazon is one of those that are hard to measure as well. Like a lot of these hyperscalers, it is hard to measure what their capex is going to do and if it's going to give the returns they want it to give. And my thought process is if all four of these hyperscalers truly believe that it is realistic or that it is going to give a reward of spending hundreds of billions of dollars a year, it wouldn't make a ton of sense in my mind for all four of these companies to be completely wrong. The four of the largest companies in the world really are completely wrong about such a massive thing. It doesn't make a ton of sense to me. Amazon's an amazing company. Let's look at their numbers here. Okay, revenue is growing 16% year over year. Revenue by segment is growing well. AWS consumer commitments are through the roof. Operating margin's good. Zoox isn't doing any rides, so I don't care about that. Again, I can't measure free cash flow right now. Net income going through the roof. EPS going through the roof. 5 years at 28% growth. Just incredible. I can't even. This company's amazing. There's a reason it's my largest position. We can assume a 20% EPS growth rate. I think that's perfectly fine. And I believe a strong multiple will trade at is between 28 and 32. I think 28 is fine. Even if we don't get multiple expansion and it just this earnings growth, you're going to get a 20% return here. You can even assume like same rate as Google with a non-expanding EPS or a non-expanding PE ratio. You get a 14% return. I believe my portfolio from where I bought these stocks at, like we can go over here. It's not like I'm down on these positions a ton. I caught majority of these on really large dips, or I'm up on the company. I'm down a bit on Microsoft. It was down 40%. I'm only down 15%. That means I avoided about 25% of that dip, which I like. Amazon, I like. I really like where I'm positioned right now. So my goal is to continue adding to these companies, build an insane portfolio, get close to 15% returns if I can. I'll try my best. I'll be as disciplined as humanly possible and do whatever I have to do to get where I want to be. So that's my entire portfolio. If you guys have any questions, feel free to leave them in the comments. Make sure you subscribe if you want to see more videos. I know this is my first video on the channel. So if you guys like the video, subscribe, leave a comment on what you want to see next, and I'll see you in the next one. Ciao.